Right. Well, I think it's as good a time to start as any, really. So once again, to those of you who arrived after my introduction to a webinar, welcome to a webinar, Energy Storage in the US, Building the Financial Business Case for Battery Storage Projects. As you could probably tell by looking at me, I am not Belen Gallego. I'm Carlos Marquez. I'll be your moderator today. And yeah, right, so we'll have three experts let us know what they are seeing in the battery storage market in the US, and especially from the financial point of view. So it's a very good opportunity for you to ask your questions. And as I told you before, we will be recording this session and sharing it with you after the webinar in a few days' time, not immediately after. And I encourage you to send us your questions through the Q&A box. So Valerie, if you could stop sharing the screen so we can start with a round of introduction. So well, now I'll get each of our speakers to introduce themselves, and I'll start in alphabetical order with Andrew. Andrew, would you please briefly introduce yourself, please?
Sure. So I've been with CIT Bank for about 13 years, covering power and renewables financings. And prior to that, I was at GE and also MUFG in the same role. And as the industry has morphed, earlier on, most of the power financings were gas and coal type financings. But now they've morphed more into wind and solar, and as well as battery storage. So happy to be here, and thank you for inviting.
Thank you very much, Andrew. And Krish, would you please say some words about yourself?
Sure. Krish Kumar from ES Volta. I'm the CFO of ES Volta. Joined the company about a year and a half ago. The company has actually doubled in size in terms of assets. I've been in the power industry for over 20 years. Prior to ES Volta, I was an officer of NRG Energy. Before that, I was an officer at Edison International subsidiary called Edison Mission. Done a lot of wind and solar projects for a long period of time. Prior to that, I was with a company called Intergen and financed a lot of projects internationally, especially in Latin America and Mexico. Thanks for inviting me to this.
Thank you. And last but definitely not least, Jose, if you could please introduce yourself.
Sure, thank you, Carlos. I'm Jose Tellechea. I'm a project manager for the North American Development Bank. The North American Development Bank, real quick, is a US and Mexico government-owned bank that finances environmental infrastructure in the border area. I've been working on the renewable energy team for 9 years now. Our team has financed around a little bit over 3 gigawatts of renewable energy projects in the border area of the US and Mexico. And I was the project manager for this particular project that Andrew led on the financing side and that Krish developed. So thank you for the invite.
Well, thank you. Thank to all of you for being here. So, right, let's get the conversation going. So could you please let us know what's happening, what's the current situation in the US regarding the storage market?
I'm happy to start, Carlos, because we're a developer and operator of energy storage assets. ES Volta was formed by my CEO, Randy Mann, about 3 years ago, and we have 2 operating assets in California. I'm sorry, 1 in California, 1 in Ontario, Canada. We have a total of 2 operating assets, and they're operating over 3 years now, lithium-ion battery storage projects. And we have 2 under construction in California, and 7 more projects coming, will be going into construction later this year and next year. Most of these projects, or all of these projects, are actually in California, because California, as you all know, has had the head start in renewables, and they've met their 30% renewable mandate, and they're now marching towards 50% renewable mandate by 2030, and then even further. So they've been by far the most advanced in terms of energy storage, and the ISO, Cal ISO is pretty advanced in buying ancillary products for energy storage. So there's a lot of activity in the last 5 or so years in energy storage because the battery storage costs have also been coming down considerably in the last 10 years. So pretty much the energy storage is experiencing a huge amount of growth in California. But now from this year or even late last year, what we started to see is other states are coming into fray in the energy storage space and looking at especially New York, New Jersey, and Texas, and also other states looking at energy storage as an alternative to gas peaker projects. So we're seeing a lot more activity in the entire United States as opposed to just seeing only in California. And that's the biggest difference we are seeing in the last year or so, especially this year and late last year. So I think we're going to see unprecedented growth in energy storage in all the states in the US, basically because it complements renewables and it replaces fossil fuels. And it solves the intermittency problem that renewable projects pose. Like the wind and the solar projects are, at the whims of God, right? Because they're not running like a coal plant will. When the wind blows, the wind really produces power and the sun shines. The solar produces power by the evening. It doesn't. So energy storage really plugs the gaps that are left behind by renewables. And the amount of energy storage right now in place compared to renewables is very, very small. Even though we have seen a lot of growth in the last couple of years, it's still very small, compared to like I said, 36% of California generation is renewables now, but the energy storage is far, it's probably in single digit as a total of generation. So we're here to see a huge amount of growth. Basically, where we are today is where we were 15 years ago in solar. Solar panels were new, PV was coming into play, and there was a lot of technological development. So PV costs were coming down significantly, and solar has become part of the norm today. I think we're going to see that in energy storage pretty soon throughout the country. And especially with the plan, the climate, $2 trillion climate plan, we don't know if that's going to go ahead, but if that goes ahead next year, we're going to see even more growth in the energy storage. So let me stop there and get views from Jose and Andrew and what they're seeing from the lenders and the investor side.
Yeah, I can second that the opportunities in the financing space for battery storage have really ramped up in the probably last year or so. I think ES Volta, this financing really created an opportunity where we were able to get our hands around the risk aspects of a kind of a nascent, a very new market. And I think, as Christian mentioned, it's very complementary to the renewables, the intermittency of the renewables. It solves a significant problem. And again, the costs have come down significantly. I remember just about 5 years ago, I had a conversation with a battery storage sponsor that also was doing a financing that we did early on. And that one, the costs were almost 4 times higher than here. So you're definitely seeing lithium costs, the balance of batteries, the costs are coming down significantly. So I think more RFPs are coming out in the market, that we are definitely having a lot more opportunities. And if this $2 trillion climate change plan does go forward, we're going to see even more abundance of opportunities, especially if tax credits are allowed in the battery storage space as well. And to Chris's point as well, it's not just centered in California anymore. There's a large amount of renewables, as Jose and I can attest to in driving out in West Texas. And we're going to see even more growth, especially with the intermittency and the balancing issues. So, and we are getting a lot more inquiries. So we're very pleased with the opportunity, be able to help Chris solve that, have a solution there, and we're looking forward to many more opportunities as well.
I would just add to Andrew's and Chris's comments a couple of data that I found from Bloomberg that explains why we're seeing this growth. I mean, the U.S. market is now the biggest market in the world, and it's expected to keep being the biggest market in the world for energy storage in the upcoming future. The levelized cost of energy, for example, is now around $150 per megawatt hour for a 4-hour duration battery, according to Bloomberg. That's half of what it was only 2 years ago. And that, as Chris mentioned, that actually puts it in right there to compete with peaker plants. So it's now, cheaper to put batteries rather than building peaker plants. And of course, it's more environmental friendly. So that, in addition to just solar, levelized cost of energy of solar is now under $30 per megawatt hour. That is just a push towards more projects. And as Andrew said, we on the financing side are actually seeing a lot of these projects being built and starting to be looked at. Right now, there's not a lot of players in the financing space, but there's definitely a lot of people looking at it now. I think CIT with this project actually led. It's one of the first, and we can explain. Andrew can explain it better than me, but this is definitely a first for many reasons. But we're definitely seeing that now there's interest in the banks, and they're starting to really take a look into this sector because it's just growing so much and the costs are declining so much. So I think as a development bank ourselves, we're really interested in this sector. It complements the projects that we have been financing in the last 8 and 9 years. And it just makes sense. And as renewables keep being part of the energy matrix of other states, the actual need, physical, technical need for these systems starts growing, and thus there's just more projects. We expect some policies also in place within different states and at the federal level that will definitely push the sector to even growing more. So we really think this is a great opportunity for all the people involved to push both more renewable energy and the battery storage systems overall.
I would just add one more thing, just to give you a feel for why we're expecting the growth, why we're seeing a lot of the growth already is energy storage, especially lithium-ion battery storage projects, can be applied in many ways, right? So some of our projects are to complement renewables, like we talked about. And that's basically providing grid stability, and specifically what we call as frequency regulation in California, is providing essential service to renewables. And the ramp up, ramp down time that energy storage can offer is seconds compared to a gas peaker project that takes 15 minutes, 10 to 15 minutes. So there's just no comparison to what energy storage can do to complement renewables. We thought, gas peaker projects were a good problem to solve, good solution to intermittency 10 years ago. But now here we are, energy storage can plug the gaps so instantly compared to gas peakers. That's one. Second use for energy storage is transmission deferral. The utilities are finding ways to defer billions or millions, if not billions, millions of dollars of transmission costs deferred. Instead, you can have energy storage for the period of next 5-10 years and solve the congestion problem, grid stability problems, and then worry about upgrading the transmission 10 years later. A couple of our projects are actually doing that. Our project called Tierra Robles in Oakland, California, is it has 2 contracts, one with the East Bay CCA and another one with PG&E. The contract with PG&E is essentially to defer a significant amount of transmission costs for utilities. So this isn't just the renewables transmission intermittency problem is definitely one. So the second major use we find is utilities' ability to to defer transmission costs. Two of our other projects that are under construction is also deferring some transmission costs at a distribution level, not at the utility level. So those are also providing essential service to utilities that they want. And the third that Jose hit on is the major use for energy storage is it's becoming because of the cost coming down, it's becoming a viable replacement for gas peakers. So that's where a lot of the utilities in the rest of the United States, even in the Midwest and other places where renewables are there, but they're also doing a lot of what we call as all source RFPs. Basically, all source RFPs mean any technology can compete and bid into the RFOs. So energy storage is invited more and more to bid into even gas peaker type of projects, where that's why you're expected to see large energy storage projects starting to replace gas peaker projects. And of course, you're replacing fossil fuel plants. So there's another climate change type replacement happening there. So renewables intermittency is one, grid stability, transmission upgrade, deferral of transmission upgrade cost for utilities is second major reason. And the third we see is replacement for gas peaker projects.
Thank you very much, Krish, for outlining, the drivers of different drivers to the storage market in the US. So essentially, you're saying that now, from what I could gather, that and just to summarize the main points you made, that we started with a strong market in California, and now that's expanding to other places like New York, New Jersey, and Texas, and you see, strong growth being driven by the growth in renewables, by the desire to defer investment in transmission infrastructure, and also to regulate frequency. And now we have a number of markets here that, across the US, and I'm sure like more will come on stream as well. As Jose said, the US is expected to continue being the largest market for energy storage in the foreseeable future. But what are the differences between those markets, and what are the different ways in which companies can monetize the storage investments in these markets?
I can start certainly, and then have Andrew and Jose chime in. So primarily in California, like I said, it's by far the most advanced in terms of energy storage. So the market's developed for different contract types. Some of our projects have capacity-only contracts, long-term capacity contracts. So basically, we're the California utilities were required by CPUC to bring in energy storage capacity to the market by certain dates, by certain time. So they're what we call as the CPUC mandates. So the utilities signed these long-term capacity contracts from players like us, like ES Volta, and providing, basically we get paid capacity payments for bringing in energy storage capacity for a long period of time. In addition to that, we're allowed, or we have the flexibility to bid into Cal ISO markets, which is ancillary services market, to provide frequency regulation services, what we call as regulation up, regulation down, spinning reserve, black start, and all of those voltage support. All of these services can be provided, and the products are pretty well advanced in the Cal ISO market. So that's one type of contract structure. Another type of contract structure is very similar to what you've seen in the gas markets, or even wind and solar, primarily in the gas market, is what we call as a tolling contract. One of our projects has a long-term tolling contract. So that basically means that you're not only contracting your capacity, you're also contracting the dispatch rights and the energy or transmission service, whatever you can provide with energy storage. You're basically contracting all services to the utility in a fully wrapped tolling contract. So basically, you're not allowed to go do sell any other product to outside the utility that you contracted with. So that basically is a fully tolled, fully contracted asset with the utilities. That's a second type of contract you can enter into. The third that's very popular increasingly is what we call as CCAs, community choice aggregators in California. They're basically backed by cities and municipalities, have been mandated by the state statute to procure energy storage for the particular cities and the municipalities. And they can contract with players like ES Volta and complement what utilities are already doing. This is really ways to ramp up energy storage, and they've been doing this in solar for quite a long time, at least for 5 years that I can see. So we see a lot of activities from CCAs. So basically, from a bunch of cities and municipalities acting as procurement agencies for those cities and municipalities and contracting with energy storage companies like us. So that's another way. But that's California. But if you branch out to ERCOT, we don't have an established capacity market yet, but there's a lot of talk about markets coming into play. It's a different type of market. It's merchant market, and the energy market, essentially, energy storage projects will play in more of an energy arbitrage role, taking in energy and at a certain price and putting out energy back to the grid at a certain price. Obviously, you want to buy in low and sell high. So it's more of that market developing fast. PJM, they do have a demand response market. PJM has this 10-hour requirement, so the energy storage is difficult to play in that market, but it's also changing fast. New York, New Jersey is coming up with the market standards, very fast. So we're going to see huge the market dynamics in New York pretty soon, and there are projects already being built based on the merchant markets. So it's and there's also state level incentives in New York that's helping energy storage quite a bit by NYSERDA. So there's different ways these markets are developing, and it's hard to predict which markets are going to go faster than what. Certainly, California has made a lot of headways, and other states are catching up pretty fast.
I think kind of to elaborate on Krish's market comments, early on when we look at the ES Volta financing, really give a lot of credit to Krish and the ES Volta team for seeing a market disruption where there was a need with the duck curve in California for frequency reg and other ancillary services opportunities. And so when he came to us and presented the opportunity, CIT, we pride ourselves in doing things that are a little bit more nuanced, that have a little bit more of a merchant or market risk exposure, because, frankly, if we wait and do more of the plain vanilla items or plain vanilla type financings, I think a lot of other lenders would jump in fairly quickly on those opportunities. And then also really a lot of credit to those the NADB as well as the other lending the other lenders in this financing for getting there on the structural elements of the market and being able to find not just looking at just contracted, strictly contracted revenue streams, but being able to get the hands around the frequency reg opportunities and seeing how that revenue stream can be fairly sticky. So I think there's definitely that's how part of how we got there. We pride ourselves in looking at the contracted plus the merchant element of the cash flow stream and being able to find a solution there. Where we're seeing in other markets now, in Texas and in PJM, is you have frequency reg and also as Christian mentioned, energy arbitrage. There are ways to de-risk around that. We are seeing other like hedges and some other opportunities that people are looking to put it on place. And another restricting factor in the kind of battery storage space is in a solar project, you may have a 15 to 20 year contract that you might be able to amortize over. One of the bigger restrictions on the battery storage is mainly the battery degradation, and it tends to be much shorter term. And I think that's where we're trying to get our hands around on the technology. Strictly speaking, this is all lithium ion at the moment. We haven't really seen anything else evolve, just because I think lithium ion is known and it's proven.
And I would just jump on that last comment from Andrew. I think they've explained pretty well how the different products that the batteries can offer. I think one of the biggest challenges or for just the battery systems themselves is that all of these products sometimes compete with each other. So if you're delivering one product, you cannot deliver another one. So getting the best mix of which product you should be offering, depending on which market you are at, and which how the value of those products you're looking at, you expect them to be. That's a very interesting and very complex thing to determine. I think ES Volta's actual hands-on experience with 2 projects already made the lenders feel comfortable that they understand this complexity of the markets and how they can take advantage of the different products. So I think that's important to understand from the lender side. This is not a you get this, you sell energy and you get this price, and if you don't, you have a P50 probability of producing X. It really gets very, very much more complex in terms of the revenue streams. But jumping into the specific technology part, because I'm seeing a lot of questions here regarding other technologies. As Andrew just mentioned, 99% of the projects today being actually built are lithium based, and it's a mix of both that energy storage is being done because this is the proven technology, but you also have all these electric vehicle technologies that are based also on lithium ion. So that's driving that's creating a lot of demand, that's driving the prices really down. And then you even have more fine-tuning and better technologies even inside these lithium-ion batteries. So in the foreseeable future, at least from the lender side, I think bringing in new technologies adds an additional layer of risk that lenders might not be ready to take when you have all these other projects that are actually being done and being built with lithium-ion. There's a lot of opportunity for sure. And I think it will get to a point where it will depend on the specific need of the battery. As we said, there's a lot of products. So in certain areas, a certain technology for a very short duration might be enough and might be cheaper, and so that might be the best fit. In other areas, like Chris said, PJM has a 10-hour criteria right now that is tough to meet with lithium-ion batteries. But there will be technologies that will do 10, 20 hours. So it will get to that point where probably a lot of technologies will have a place to play. But I think we're still kind of far away from that, and lithium will continue to dominate the market.
Yeah, it's a good point, Jose. I mean, I see a lot of the Q&A about, will the lithium-ion batteries have extended duration? I mean, the longest I have seen, or ES Volta has been working with, is actually it's either 2 hours, 4 hours, or 8-hour duration. So 8 hours to charge in and 8 hours to charge out. That's the maximum. Obviously, 8 hours will cost a lot more because you need a lot more battery cells, right? So are the other technologies, I'm not really qualified to talk about a lot of the other technologies because we specialize mainly in lithium ion. But certainly what I've heard is there are technologies that can provide longer term duration than lithium ion can. But I think that the real question is it proven? Is the scalability there? Can you build on a commercial scale that's needed for the utilities? and certainly pumped hydro has been around for a long time. And there's debates to be had, but certainly if we stand where we stand today, like Jose said, lithium ion is definitely a safer bet, right, than anything else.
Right. Well, looking at the project pipeline, it definitely looks like looks that way. Talking about something slightly different but related is that we're obviously now in the middle of a crisis, brought about by COVID-19. Is financing available? How has that affected financing for storage projects in the US?
I could take that. I think COVID-19 has impacted financings overall, but I think from the renewable space and energy space, it's actually been pretty consistently stable. I think there's a lot of deal flow. I know in the solar space is still going pretty good. I think on the battery storage side, we're still seeing quite a few opportunities. So I think that the only impacts that they're having is mainly, and Chris could probably elaborate on it, is more having equipment shipped from China. There might be delays, but I think overall, I haven't really seen volume in terms of loans go down because of COVID-19 or any projects being canceled. Maybe some of the smaller developers might be having more stress because they would have to have more cash flow to be able to I guess make their way through this through the storm, through events of defaults, or just having just this time to be able to cover off. But I think overall we have not seen volume actually drop off. So I think in that sense, I think the financing market is still, the financing market in general for battery storage has always been a bit more smaller in terms of not a big array of lenders, as there's more market, more structuring elements involved in it. So it's not as middle of fairway. So I think in that sense, that's gonna drop some players. But I think overall the ones that are currently in play are still there. And so unless, Jose could also elaborate on that if he's seeing any drop off. But I think from our perspective, we are seeing quite a bit of activity still.
I can speak to from project development and sponsor perspective, right? We closed our first financing with CIT, NatBank, and other banks in February, and then COVID actually hit the US pretty hard since March. And so we have actually added another project called Black Walnut to our portfolio. It's with the CCA in California. And we're also looking to add 2 more projects by end of the year. So has COVID really, changed the market dynamic in energy storage? I don't think so. So here's my experience in through the business cycles we have seen in Great Recession and in solar wind days in the last 20 years. As long as there are good projects, the capital providers would always be willing to lend, right? And as long as there's a favorable regulatory landscape encouraging renewables. I believe renewables are here to grow in terms of cost competitiveness and also from a regulatory standpoint. And when there's renewables, there's going to be more need for energy storage. And as long as utilities are mandated and required to produce, to sign additional projects, more projects are to come into the picture. And as long as there are good projects with good contracts, the capital providers like CIT NetBank will always be there for the right projects. Having said that, I wouldn't say everything's rosy in terms of project development and stuff. It has impacted from a short-term perspective, like Andrew mentioned, the supply chain. A lot of the battery cells are manufactured in Asia, so you can imagine Asian countries were hit pretty bad in COVID, and also the transportation, and the US and California and getting, so there are a lot of supply chain disruptions we've seen with inverters, transformers, and getting the battery cells shipped to here. And we have also seen construction delays because of shelter in place. Energy storage is considered to be essential, but there are contractors that don't want to do it when the things were really, really bad in California back in April when there was a shelter in place, because you don't want to put people's lives at risk building a project. So you're experiencing delays. So I would, certainly say that there are impacts by COVID-19, but over the long term, just like in any other industry, but this industry I think is a lot less impacted in terms of need for energy storage. So the short-term impact, the impacts that we have seen are mainly short-term.
I would just add to that. I think I would stress, as Chris mentioned, if you have a good project, you will find the resources. There is liquidity in the market for this type of projects. As Andrew said, there's not a lot of players. I think CIT is one of the leaders here. So NatBank is restricted geographically just to the border area, but we are definitely interested in this space. And as a development bank, we want to see this sector keep growing. And in addition to that, I think, as Chris mentioned, when you have the regulatory framework in place, I think that's also very important. It will be very important for the upcoming projects. Just trying to touch here a little bit on several of the questions here that we are seeing. I think those regulatory frameworks are not there for example, in many developing countries. So definitely an uphill battle there for developing countries to really start a storage market in the short term, at least. I think developing countries might have arbitrage opportunities for the most part, but other than that, you might not be seeing any additional revenue streams, and that itself might not be enough for projects to being built. But there's definitely I think a trend overall in the world to start using these systems more. I do think, again, because the way things are in terms both of regulation and actual penetration of renewables in the matrix, I think the US is still going to be the most important market.
Well, thank you very much, Jose, for that point there. I think that by hearing some of the points that you've been making, so COVID-19 maybe has played some short-term delays in some projects, but actually good projects are still going ahead, like solid projects, and that's what you think will keep going on for the foreseeable future. So it seems a fairly stable industry, and there are a couple of additional points we have planned to cover here. I think, Chris, you've actually touched upon some of these, but I can see more and more questions about these particular topics. So, which is about the offtake structures for the different services provided by storage products. So, could you please provide an overview of those?
Yeah, I think I covered it earlier. I mean, I'm happy to go over that again. Like I said, California, by being the most advanced, there are different types of contractual structures, right? One is providing a capacity-only contract with the utilities, and then able to sell energy and ancillary services, primarily frequency regulation, to Cal ISO market. So that's one type of structure. And the advantage and the disadvantage of that structure is the advantage is all of the revenues are not contracted, right? So you have the capacity contract that's contracted with the utility, but the ancillary services contracts are uncontracted. I wouldn't dare calling it merchant, because it's really not a merchant play like a long-term gas play in PJM, or a coal play in ERCOT, like looking at a dark spread, a spark spread, and taking a projection of how the gas price is going to look 15 years from now. That's really not what this is. This is providing essential ancillary services to the grid, providing grid reliability. So the ancillary services market are uncontracted in some ways, but they're not same as merchant revenues. So that's one type of contractual structure where you have a mix of contracted and uncontracted revenues. And a lot of our projects do have that. And there's a second type of contract where you are fully contracted, what we call as a tolling contract with the utilities. That's essentially a replacement for gas peaker type project, where utility wants to take all of the services and the capacity. So where you have 100% of your revenues from the project are coming from the utilities, or from large trading firms and corporations. It's, I want to note that one of our projects is actually fully tolled with a large trading company, which is also, I believe, is the first in the energy storage. So it's, we are starting to see non-utilities also coming into this market. So that's the second type of contract, which is a fully contracted tolled project, either with the utility or with a trading counterparty or with large corporations. And the third is a mix of, either 100% merchant and taking advantage of demand response type projects, but those are more behind the meter type energy storage assets, which ES Volta doesn't do. We specialize specifically on utility scale, front of the meter type projects. But if you have behind the meter projects like in PJM or in California, you can participate in what is called demand response type of products, the contracts, where you're basically asked to, when the prices peak at certain point, when the ISOs ask you to shave the load, you would be willing to reduce the load and get paid pretty high prices for those high demand or high load hours in a year. Those are only few hours, but if you're there to provide that peak shaving service, you get paid for that. So there's a lot of behind the meter type projects that take advantage of that type of contract. So those are primarily what we have seen. We also see large contracts, including obviously solar plus storage. That's another space we don't play. That's combined with the existing solar or new solar projects, adding energy storage to it that has long-term contract, in addition to a long-term offtake with solar contract, and that comes with tax incentives. So the solar plus storage, I view that as a very different world within the same sector, even though it's energy storage, but it's got advantages and disadvantages with it. So there's, depending on what type of energy storage you're looking to build, is it standalone, is it front of the meter, or is it solar plus storage? There are different contract structures that I've just walked you guys through.
Right, and based on the projects that you have developed, Krish, what are the lessons learned there?
It's important to have a mix. You don't want to do obviously fully merchant projects. You want to have a mix of what we call as RAs in California, which is a mix of contracted and uncontracted assets, because you want to be able to participate in market upside, should there be market upside. And you also want to have projects that have reliable, fully contracted cash flows, which is like the tolling contract that I mentioned. And so it's important to have a mix of those cash flows. And that's one type of diversification you want. The second level of diversity or diversification that we're looking for is moving into other states other than just California. So different markets, different utilities exposure as opposed to only California utilities. And the third would be different technology within the lithium ion space. There's different chemistries within lithium ion space, which we may look at in the future. Although we're very specialized within the lithium ion technology, we use what is called LFP chemistry. There are different chemistries available. If you want higher density energy storage with slightly higher price, higher cost, I mean, but it provides you with more density and more power, that's possible, which we haven't really gotten into. So those would be the areas we'd be looking for. Diversifying in terms of contract types, diversifying in terms of different states, and diversifying in terms of different chemistries within the lithium-ion space.
I would just add from the lender's perspective, I think, I mean, we've covered all the financials, but we also definitely need to take a look at, you know, who's playing in the project. And I think Krish's team was able to get a very good team of companies involved, you know, battery integrators, the actual sales, who's producing the cells, what's their track record, how's their safety record, etc. And I think there's not that many players right now that are that have sufficient you know, projects on the ground to make lenders feel 100% comfortable. But I think Krish worked with quite a few that do have the proven experience, and so there's definitely that aspect to consider too, because even within the same technology, there's different providers, and there's providers that are just starting, and there's providers that are a little bit more experienced. So I think that's another important point from the lender's perspective.
Yeah, I mean, I could further that sentiment with Jose. I mean, you know, proven technology is definitely key. So unless like flywheels or anything else, you know, if Elon's willing to put it in his cars and we can see that go for a duration of time that works, hey, we'll look to try to finance it. But otherwise, yeah, I think we're sticking to lithium ion. That's why these gigafactories are being built, right?
Right. So, you know, we have a question here, which I think is interesting for the, well, for all three of you, actually, which is, what is the biggest financial risk in a battery energy storage system? And any tips on mitigating that risk?
Carlos, can you repeat that? I think you were cutting off.
Yes, the question is, what's the biggest financial risk in a battery energy storage business?
There are three things when it comes to energy storage that you want to focus on. The engineers look at it, investors look at it, we look at it as a sponsor. That the first thing is these batteries don't live forever, right? So these batteries degrade, and so what is called degradation curve, you want to look at how fast these batteries degrade. And in theory and in real life, this could be a little different. And the second, so the degradation is very important. That's something independent engineers heavily scrutinize, which is why, you know, our operating projects that we have 3 years of operating history, which demonstrate what level of degradation we have experienced and why is it more in the first year, and then it's slow, you know, the degradation slowing down in the future years. And all of that is very important. So that's an important risk to consider when you build lithium-ion batteries. The second is what we call as efficiency ratio. So every megawatt hour that goes in does not mean you get full, you know, megawatt hour that comes out. So there's efficiency ratios range between low 80s to high 80s% of these battery storage projects. You want to look at how the efficiency ratio works in a specific technology or chemistry that you're talking about in the project, because that's real dollars, right? Because that translates into if you're losing, 40% of the power that you take in that you can't put out, and that's a huge problem, right? So the efficiency ratio is second. Third is a lot of the operating characteristics, like temperature. The battery cells want to, don't perform beyond a certain level of extreme temperatures. You want to make sure that there's enough cooling around the projects, the cooling systems, and you want to maintain certain band of temperatures for the cells to perform within normal levels. So when you enter into a contract, you want to make sure degradation, efficiency ratio, these operating characteristics are properly reflected in your contracts. and you have sufficient warranties from the vendors to stand behind those. And the third is what is called augmentation, is a very famous term within the energy storage world. As the batteries tend to degrade, typically below 70%, you want to replace them and augment them with the newer battery cells. And that it's pretty much like your car. I mean, your battery doesn't go on forever. After 3 years, you want to replace your battery, right? So that they look at the degradation and the capacity level of what I call a state of health, SOH, and replace that. I mean, all of these are technological issues or parameters that you want to keep in mind, but those turn into investment risks for not only for sponsors, but also for lenders, right? So those, I would say, are primary factors you want to consider. And the fifth, and actually I don't want to, this is the last thing I mentioned, but actually it's very important, is fire risk. And there's a lot of concern about energy storage and the fire risk. And obviously it has to do with what chemistry you use within lithium ion, and how the software works. When one cell catches fire, you want to make sure that it doesn't transmit to other cells. The software's ability to capture that and shut it down is very important, and ability to have fire mitigant systems is very important. So those are real issues to consider and keep in mind, and you need experienced engineers, experienced lawyers, and the contractual commercial people to make sure that you understand what you're getting into, because those turn into huge financial risks. Andrew?
Yeah, I think just to expand on that as well, the degradation is one of the big areas that we look at on these batteries. And as Volta's case, we looked at degradation in a sense of the cycling. We've also done we did a battery storage deal that was behind the meter that cycled a little bit less than as Volta's, but in other cases we're getting inquiries from people that are using them more for energy arbitrage opportunities, and those are going to cycle up and down quite a bit. So a lot of discussion now is moving from the degradation as well as augmentation. So to be able to augment the batteries to be able to offset some of that degradation is going to be key in some of the financings here. And obviously, if the technology does improve, where we don't have sole reliance on lithium ion and there's some chemistry breakout, then I think that would be a game changer. But for now, we are restricted to seeing these the degradation and augmentation, and to also Krish's point, fire insurance has been pretty hard to come by as well. So that's been very key. And I don't know, I think fire insurance has definitely gone up for future projects, and especially California. I think that they've been hit with the wildfires and whatnot. So that's been an issue.
So, well, I think you've mentioned there are a number of risks. So, I'm sure the person who asked the question is happy really to hear all of these outlined. There is another question which was about, and we're actually coming, we're kind of running out of time here, but I think we have time for one last question. And the question was about the typical length of the storage contracts being signed now in California, I think it said, which is the most mature market in the US for energy storage. So any orders of magnitude of the lengths of?
Yeah, happy to. I mean, I think those have been public information, so I'm happy to divulge that here. So typically it ranges between 10 and 20 years. Mm-hmm. There are contracts with 10 years. There are 15 and 20. I have not seen longer than 20 years because the energy storage projects are considered to have 20-year life, and I'm certainly there's like beyond that remains to be seen. So that's the length of the contract we have seen. It's either 10, 15, or 20. And there are shorter term contracts too, but that obviously involves more financial risk about recontracting, right? If you enter into a 5-year contract, then what happens after 5 years and what's the ability to recontract? And as long as there's a need for energy storage, I'm sure the recontracting risk is less, but that's something you have to address. But typically you see 10 to 20. And one more thing I'll mention, that there's, looking at a lot of Q&As, I think there's one question about, hey, what about pollution risk about recycling batteries? At the end of, everybody's talking about lithium ion, and is it environmentally friendly at the end of project life? You're throwing all these batteries away. That's a very viable concern. We are looking into a lot of methods of recycling because the industry is still nascent. We haven't really locked into a specific recycling plan. One of our battery manufacturers, CATL, that's something we plan to use for now, all of our future projects, has bought a recycling company that is, so the recycling is a huge corollary business to energy storage that's coming up. I have even seen the different types of recycling technologies coming up by water and fire-based recycling technologies. And, so that's something the industry must address and has to address.
Oh dear, I think we've lost Krish for the final part of the webinar. I think, well, luckily it was like literally right at the end. And just to continue what he was saying, I think that could even be a topic for a webinar of its own. The recycling of lithium-ion batteries, particularly given how the rate at which they will be installed, and not only in power generation but also in transportation as well. So, yeah. So, Shane,
I would just add, Carlos, to that very quickly. I think just like with any technologies, and like Chris said, 15 years ago, we were financing panels that were had, maybe they were 15%, had capacity factors of 15%, whereas now it's more than doubled. So I think there has to be a point that you need to start financing technologies for them to evolve and become more efficient. So definitely, it's clear that storage is required to allow the integration of renewables. Once you pass a certain threshold of renewables in your grid, you're gonna require energy storage. So there's definitely an overall offset of the impact, of the environmental impact, when you take into consideration all these pieces. But there's definitely room to improve and to have more efficient and cleaner batteries, and then more efficient technologies. But I think what lithium ion will definitely prove is that storage works, and that will probably be good for other technologies that will come in the future.
And just to emphasize on degradation and battery contracts, we typically, a lot of, even though Chris was saying that some of the contracts can go up to 20 years, a lot of the financings are going to be shorter term, more closer to more of a 10-year time frame, because the degradation of these batteries typically show the useful life around that range. So it's definitely shorter than the 20-year life cycle.
Right. Well, Andrew, Jose Miguel, and everyone in the audience who has stuck with us, thank you very much for today's webinar. It's been very interesting. It's been a pleasure being here with you today. And well, I don't know if you want to have any parting words for the audience.
Just thank you for participating, and we appreciate listening in, and we thank you, ATA, for setting this up and giving us the opportunity to share this battery storage opportunity I had with Krish. Unfortunately, he dropped off, but it was really a pleasant opportunity to be able to work with the SVolta team, as well as NADB and the rest of our bank group, that we really was able to execute this successfully. Really, it was all parties involved that made it possible. Thank you.
I would just extend what Andrew said. Thank everybody for their time, and I think it's a great sector. If you guys are in this webinar, it's because you're in the right sector. It's definitely something that's growing. There's a lot of opportunities, business opportunities that will also have a positive impact in the environment and will help with the integration of renewables. So we hope to continue participating in webinars like this and seeing more projects come to fruition in any country, but especially here in the US.
Thank you very much once again. And well, see you here next time. If you like this kind of webinar, you know where to find more. Go to adainsights.com and we'll have a lot more webinars coming up for you. And well, thank you everyone and have a good day.